The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning and welcome back to the Financial Exchange on an inflation week here, where tomorrow morning at 8:30 we'll get the release on CPI. In the meantime, continued news out of the Middle East signifying not much of all. It has been an interesting kind of shift out of there, where we are getting less and less information, it seems, compared to the very early stages of the war. But we have definitely settled into an uncomfortable status quo when it comes to the Strait of Hormuz. It's Mike, Paul, and Tucker with you here, and I was alluding to our starting story of the day, this piece from Bloomberg about why restoring normal traffic to the Strait is proving just as difficult as it is. And I think to those who were experts in the region ahead of time, it's not proving, so surprisingly difficult. I think, when I listened to experts very early on, it was, this entire region is defined by, very mountainous rural areas where you can hide all sorts of weaponry. With the new advent of how drones are used, it is pretty self-explanatory why the Strait of Hormuz, reopening it, is proving quite as difficult as it is. And so hence we sit here 1, 2, 3, 4, 5, what is it, six months out nearly now from the beginning of tensions in the Middle East, with no real progress that can be discerned on the flow of oil and any sort of change of stance with Iran here. I think the changes that I was alluding to earlier come from not Iran or the United States, but rather the neighboring countries around the Middle East, who early on we were seeing a lot of reporting in those countries about strikes in the area, and many of those countries have now clamped down on that posting of videos and any sort of external media, whether it's Western or not, from being able to be recorded there. There were a few people, I think, in Saudi Arabia last week who were arrested for posting videos of not even confirmed strikes, but smoke in the area. And so on one hand, you have all of these countries who are very much struggling and pushing for some sort of negotiated deal, while simultaneously trying to reaffirm to the world that this, the Middle East is open for business and able to be invested in, traveled through, and has a future as a stable region. And it's becoming increasingly difficult to convince the public that that's the case these days.
No, if you look at the most recent shipping data that we've seen on the Strait of Hormuz, there were reports from Reuters that we saw about 6 vessels travel through the strait. Yesterday, the 10-day moving average has been about 11 vessels, a far cry from the 130 to 140 that we saw pre-war. So I think it's going to be harder and harder for those countries to make the argument that it is open for business. And you can bet that there are many countries and companies throughout the world that are probably already taking the steps to invest significantly to find alternative ways around the strait for the future. Does that come online in the next 3 or 6 months? No, but it's certainly over the course of the next few years. I'm sure confidence has been dented almost permanently that these countries and companies need to find other ways to transport goods.
Unfortunately, one of those other ways was the Red Sea, which is now being attacked in pretty much the exact same way as the Iranians are doing through the Strait of, Bab el-Man something. Apologies, I'm not a geopolitics expert.
But
a narrow strait in the Red Sea that is being attacked by
Red Sea
Yemeni
Strait?
Houthis. Nope, it's got a name. Starts with Bob. And so you have the alternatives being attacked in the same way too. And I think the interesting thing to me, like, if you are some form of organization in Iran just thinking through your best interests at this stage and you're working on limited resources, obviously the drive from the Iranians for the last several decades has been the development of a nuclear weapon. Some might try and debate that, but I don't think it's much in the way of debate. They have constantly sought to go and do that. And for logical reasons. Go look at countries that didn't develop it and what, the power struggle there versus those who did develop a nuclear weapon. If you've got limited resources, I'm not sure that's where you divert them now. Iran has kind of discovered a new weapon that they have in their arsenal, and that weapon is shutting down traffic through the Strait of Hormuz using much cheaper technology that's much more readily available and can be manufactured easily. It might not give you the exact same powers as a nuclear weapon, but clearly they are exerting a whole lot of pressure on the global economy now at, kind of 1/10 the effort that they had to put in previously to try and develop something that would be as much of a deterrent.
But it's such a significant cost, which I guess they're willing to bear for a much longer time than many other countries out there of economic pain. But I just don't know if the ends justify the means here on their side of things. But ultimately, it comes back to we are going to be in this period, it seems like, of limited updates or back and forth on these negotiations for far longer.
Doesn't
than
necessarily
many
mean
thought.
a bad thing.
No.
To not be getting perfect information out of there can indicate that there is progress, but it is very much settled now into this uncomfortable status quo, and I think a lot of people are starting to ask themselves, are we in another forever war here? Because for the time being, I don't see enough pressure being exerted in energy markets to push for a negotiated settlement. It does not appear that U.S. and Iranian negotiators have much that they agree on. The MOU that was put in place lasted all of a couple of days. And, the Trump administration, as much as I'm sure they are concerned about oil stockpiles, which reached, I think, the lowest level that we saw since the early 1980s yesterday, it's tough for me to look at the U.S. economy and say that it's come to a grinding halt because of higher energy prices. In fact, quite the opposite. We're seeing all-time highs in the stock market, accelerating domestic activity from the AI build-out. And so, and on the Iranian side, too, yes, is their economy in shambles? Absolutely. Is their military disjointed and broken up and their supreme leader removed? All of those things remain true. But it's now apparent that none of those have been significant enough to, I think, change their outlook on where to bring this conflict next. And so, unfortunately, I return to where I was a few months ago on this, which is I hope to see some sort of negotiated deal that leaves the United States in a powerful position and returns to see the oil flowing through the Strait of Hormuz again. But I have an increasingly difficult time seeing us getting there without a lot more pain inflicted on the Iranian side, the U.S. side, or both. And I don't know how you get there given the status quo of the last several months. Oil prices are about flat for the day as we open up here, but those remain flat over $80 a barrel. We're seeing nearly $82 a barrel on the West Texas crude price as we turn around and take a look at gasoline prices. According to AAA, national average for a gallon of gas going for just over $4 a gallon. 4.01 is the national average that we are seeing here. We are going to take a quick break. When we come back, I want to talk a bit about that inflation report that I alluded to. We'll be getting it tomorrow morning. And importantly, what that means for the new head of the Federal Reserve, our Kevin Warsh. That's next on the Financial Exchange.
Subscribe now to our YouTube page, where you'll find daily interviews and full shows of the Financial Exchange. We'll get you caught up on anything and everything you might have missed, right here on the Financial Exchange. A single nursing home stay could cost you more than $14,000 a month. That's why so many families believe they'll have to spend almost everything before a loved one can qualify for Medicaid. But that isn't always the case. Cushing & Dolan has created a new guide called Last Minute Medicaid Eligibility. In it, you'll learn how Medicaid eligibility works, get information about last-minute planning options that may still be available, the mistakes that could cost your family, and why acting quickly could give you more options. Don't assume you have to lose everything to pay for long-term care. Get your free copy of our new guide called Last Minute Medicaid Eligibility right now by calling 866-848-5699. That's 866-848-5699. Or you can request it online at legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Retirement isn't just one stage of life. It changes over time, and your home should change with it. This is Mike Armstrong from the Armstrong Advisory Group. You may have heard of the go-go years, when you're traveling and enjoying the freedom you've worked so hard to earn. Then come the slow-go years, when convenience starts to matter more, and eventually the no-go years, when safety and support take center stage. Our new guide, Navigating Retirement Housing Choices, shows you how different housing options can fit each stage of retirement. From staying in your home to downsizing to exploring elder life communities, you'll learn what questions to ask before you're forced to make a decision. Get your free copy today by calling 800-393-4001. That's 800-393-4001, or request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
From breaking news to market analysis, follow the Financial Exchange Show on X and watch the show live every day. This is the Financial Exchange Radio Network.
So, Paul, tomorrow we're going to be getting the July inflation report. Expectations are for a relatively modest report here because energy has been what's been driving up prices in the aggregate, and energy prices month over month at least, not a huge shift. Last month we saw for June we saw the overall CPI come down by 0.4%, but the core was flat because it strips out the food and energy piece. This month we're expecting a very small increase of about 0.1%, and on core prices seeing those uptick a little bit further. And this, in combination with the jobs report that we saw on Friday, has the potential to, Nick Timrose from the Wall Street Journal talks about it in terms of it testing Warsh's tough talk and further challenging his credibility on the inflation front. I'd argue that it also has the potential to really give him a lot of leeway given what we saw in the jobs report on Friday of last week. I'm not sure I interpreted that jobs report the same way that everybody else did, but from a headline perspective, you had net job loss, you had significant revisions to previous month's payrolls, and so should you get an inflation report this month that shows tepid month-over-month inflation, Warsh might be in the position of being able to justify his move of not having moved on interest rates or had much of a tough talk on the inflation front.
Well, I mean, it does put him in. It seems like the overall feedback is his public commentary has been really dismissed by a lot of different investors and reporters out there, not thrilled with his approach. But it does seem like there are certainly inflationary pressures sort of percolating in the economy, and to your point, maybe we don't get them in tomorrow's report, but let's play it the other way. I mean, you mentioned that perhaps the inflation report comes in, what are we looking at? I'd seen 0.2% month over month in terms of what the
on
increase could be looking like.
On core prices, 0.2 year over year. That still puts you at 3.4% on the headline, 2.5% on the core number.
Right.
Which granted, CPI is not the Fed's quote unquote preferred measure of inflation, but in either case, when you're printing 3.5% year over year inflation, that's not anywhere near your target.
Right, and he has talked very tough about getting inflation under control, and maybe even if you get a tepid report, though, you still are sitting at 3.5% or 3.4% inflation, and if Warsh is really focused on backing up what he's kind of come into the position stating, you would think that it would be prudent for him to potentially look to force a rate hike in September, but it now seems like there's been a dramatic shift on the probabilities market as to how tough this talk really is and if it will result in any action. I was looking at the numbers that about a month ago, it was about 70-30 in terms of the CME futures that we look at so frequently when it comes to the Federal Reserve as to whether or not they're going to hike. And the 70-30 probability, the 70% encompassed either a 0.25% hike or a 0.5% hike heading into the September meeting. That now sits at more of a 50-50 probability for the September meeting. So clearly, and we saw this after the Federal Reserve meeting with the long end of the interest rate curve spiking up, sort of showing some skepticism that Warsh is going to be as tough as he said he was going to be on the inflationary front. And perhaps some of that is because he was rather vague on his explanation for the Fed's lack of action in the past meeting, but it does sort of put him in a tight bind, it seems like, for the September meeting.
Yeah, look, I was critical of his presentation at the most recent Fed meeting. I wasn't as critical about his decision-making process. I mean, clearly there were a bunch of Fed members that wanted to hike interest rates, a number of them that chose not to, and that's how these things go. His commentary to me was confusing. I don't think it's fine to want to say very little, but when you give confusing commentary about different situations in your effort to do so, that just muddies the water a little bit and I think hits at your credibility, and nobody wants to see what happened in markets happen right after they speak. I think that's a fair point to make. The second piece on the Fed that we have here is from Bill Dudley, a former Fed member, and that was I think that was better put in terms of his criticisms for this rocky start at the Fed. And to me, it all comes down to a point we made about Jay Powell's Fed, which was there was all this discussion about changing some of the benchmarks, changing the goalpost, moving the goalpost in terms of what the ultimate goals of the Fed are. 2% inflation target, for example. Why do we have a 2% inflation target? It was kind of picked out of nowhere, and we've adhered to it through thick and thin, or at least saying that we're adhering to it. Why? Why does it matter? Why is 2 better than 2.5 or 2.25? Why do these things exist? But the point that we made was, while those are good questions, they're inappropriate to ask while you've got inflation running 3.5%.
Right.
That was the takeaway is, these are good long-term questions that we should be asking and restructuring how we're doing things here. But when you just came off of some of the worst inflation that you've seen in 5 decades, asking them before you've beaten that inflation back is not the appropriate time to be asking. And now we've got a new Fed chair. He's been brought in by the president, has been lauded by the president as the person who's going to do his bidding. Whether Warsh believes that or not, that's the president's view. He's said it several times. I don't think I'm putting words in his mouth here. He wants lower interest rates, and he thinks that Kevin Warsh is going to be the person to navigate that. And he seems to be doing the exact thing that we said Jay Powell shouldn't do at that point in time. Granted, it's a new person in there. He is not responsible for the mistakes that Jay Powell and his Federal Reserve made back in 2021 and 2022 that led in part to the much higher inflation that we saw. So I do think Kevin Warsh has more latitude to go about looking at these things and studying them critically. But I have to tell you, it's tough for me to square this very tough talk on inflation at the same time that he's setting up committees to study whether or not our current way of measuring inflation is quote-unquote the right way to do it.
That's what I think is most frustrating in all of this is his slight skepticism being placed on the current metrics in place, while at the same time adhering to them in a sense by saying that inflation is too high and we need to get it under control. And I just wish that the rhetoric around trying to reframe the way that they track inflation could just be put on the back burner for the moment, because at this critical time in the economy, when I'm meeting with clients, and I don't know how you phrase it, inflation is just one of the biggest subjects that I'll mention in terms of what we are following with the economy and the markets right now. Not to say that we think it's problematic today, but it's something that is of utmost focus at the moment, and I'd rather shelve some of this kind of rejiggering metrics for the time being.
And I think some of this comes from, again, not having, just like Powell wasn't, a trained PhD economist that's heading the Fed, right? Like he's expressed skepticism about the measurements of inflation. He's expressed some skepticism about the cause of inflation coming from the labor market. And so, while I think it might be appropriate to study, hey, how much should I as Fed chair be speaking to the public and giving foreign guidance? Like, that's an appropriate thing to look at. You're a new chair. You should figure out your policy on that. Studying what causes inflation and whether or not we should be using the current readings to do so seems like you're trying to find an excuse to not be tough on inflation. At least that's my read. We've got to take a quick break. When we return, let's talk a little bit about markets here with Wall Street Watch. That's next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. A single nursing home stay could cost you more than $14,000 a month. That's why so many families believe they'll have to spend almost everything before a loved one can qualify for Medicaid. But that isn't always the case. Cushing & Dolan has created a new guide called Last Minute Medicaid Eligibility. In it, you'll learn how Medicaid eligibility works, get information about last-minute planning options that may still be available, the mistakes that could cost your family, and why acting quickly could give you more options. Don't assume you have to lose everything to pay for long-term care. Get your free copy of our new guide called Last Minute Medicaid Eligibility right now by calling 866-848-5699. That's 866-848-5699, or you can request it online at legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
I was 24 when I had a stroke.
I was 35 when I suffered a heart attack.
I was 46.
I was 62.
It's a fact. Cardiovascular disease is the leading cause of death in women.
But we can fight against our #1 killer.
Talk to your doctor about your risk factors.
Know your family history.
Learn the warning signs and symptoms.
Together,
let's go red for women.
Visit goredforwomen.org to learn more.
Every mile can make a difference for a Massachusetts veteran. The DAV 5K Boston returns to Castle Island on Saturday, November 7th for a family-friendly day of community, remembrance, and support. Whether you run the 5K, join the 1 mile walk, or make a donation, your participation helps further the mission of the Disabled American Veterans Department of Massachusetts. Honor those who served. Sign up today at dav5k.boston. That's dav5k.boston.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Hi, it's Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Navigating Retirement Housing Choices. Mike, as you get towards retirement, what are some of the considerations for whether you should stay in the property that you've been in for a while or consider moving to a new one? To me, for most people, they come down to 2 factors. One would be financial, and 2 would be quality of life. And so, first things first, right? I mean, you're heading to retirement. Did you do enough saving to be able to afford to live in the same place you did, with or without that mortgage, with where property taxes and insurance costs have been going? So that's probably number one. But the one that people kind of start to forget about is the quality of life. And so how close am I to family? How close am I to health care? And am I going to be safe in this house 20 years from now from a healthcare perspective? It seems like for most people, they're going to have different priorities as far as which of those come first. So it very much is not, here's what you do, but more, here are the things you need to consider, and then get to your own conclusion. Yeah, but I think it's important that people think long-term on this, right? You do not want to make this decision twice. And so very often we do see that happen. Hey, I'm moving here because of taxes, and I didn't think about the other qualitative lifestyle pieces about that move. Folks, our guide is titled Navigating Retirement Housing Choices. There are 2 ways to request it. First, you can call 800-393-4001. Second, you can go to armstrongadvisory.com. That phone number again is 800-393-4001, or you can request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets are mostly quiet with more turmoil in the Strait of Hormuz after the Wall Street Journal reported U.S. forces fired on a Panama-flagged ship that attempted to run the American blockade of Iranian ports earlier today. As for a potential deal, Pakistan's defense minister said the U.S. and Iran are, quote, close to some sort of arrangement. Right now, the Dow is up only 43 points. S&P 500 edging 6 points higher. NASDAQ dipping by 15 points. Russell 2000 is up 0.6%. 10-year Treasury yield down 1 basis point at 4.68%. And oil is flat, trading at $82 a barrel. Intel down modestly after the chipmaker increased the size of its stock offering to $20 billion, higher than the $15 billion it previously announced. It intends to use the net proceeds for general corporate purposes. Meanwhile, Bitcoin miner Riot Platforms is seeing its stock climb 5% after Bloomberg reported that the company secured a $9.1 billion cloud deal with Anthropic. Riot also beat second quarter revenue expectations. Elsewhere, shares in Hims & Her falling 1% after the telehealth company trimmed the upper end of its full-year EBITDA outlook. Swiss sneaker maker On Holding posted mixed second quarter results and reduced its full-year revenue guidance, sending the stock plunging by 18%. And after today's closing bell, we'll see earnings from CoreWeave and Super Microcomputer. I'm Tucker Silva, and that is Wall Street Watch.
Before we move on, we were talking about the Fed before and inflation and these, difference between 2.5% and 3.5% inflation and, which tool the Fed uses to measure. But I wanted to get back to why this is so critically important, right? I mean, when I'm going to put this in the focus of what Paul and I do for work outside of the radio show, which is manage people's investments primarily for their future retirement. And when you talk about, risks, everyone tends to focus on the risk that they very easily understand because they've seen the risk firsthand of their stock portfolio dropping 10, 20, 30, 40, 50% back in 2008 as an example. That one's real. They understand that pretty easily. Rarely have people lived through a really high inflationary environment, but I want to bring up, the compounding effect of that inflation on retirement. So, it's not unheard of these days for people to have 30-year retirements. Mm-hmm. Increasingly common. And, if you've got a $100,000 budget in retirement, which is not uncommon here in New England, and you face 2% inflation, by the time that 30 years elapses, you're going to be talking about a budget that's more like $180,000. If it's 3% inflation, you're talking about $243,000. That tiny change in how much inflation you see has a massive impact, obviously, on compounding. And everyone's fully aware of this, but this is something that I bring up on all the time. Everyone's so focused on, what if the stock market falls apart? That is a concern, and you should be worried about it if you are close to retirement and you are an aggressive investor. The reality is that most people that are close to retirement aren't set up that way, and so most people that I meet with anyway, the far bigger risk to them than the market falling by 40% is inflation running an extra 0.5% higher than they were prepared for and being incapable of keeping up with their expenses.
That absolutely is a huge risk that looms out there. I feel like the reason it doesn't get talked about as much, Mike, is, there are some tweaks that you can make within your portfolio to try and protect against inflation, but ultimately it's a silent killer. Like, there's not a lot you can do. I mean, yes, you can make tweaks within your portfolio, but to your point, it is extremely detrimental, but there's not a huge way to wiggle your way out of it versus a portfolio. Yeah. If you have amassed enough assets, there are people in this world who just have such a lump sum savings that they could sit with it in a money market and probably coast along just okay because maybe their budget isn't $100,000, maybe it's a lesser sum, or they have a pension, yada yada. There's a million different distinctions there, and I feel like that's why there's more focus on the portfolio because it's more easily controllable versus inflation. Unfortunately, is a lot in the hands of sort of the governing bodies, the Federal Reserve, and just the economic forces that are at play in general.
It is, but that's the point that I try to make to people. Like, you can pretty quickly adjust the risk of your portfolio downwards so that you're not as subject to a market crash. Fairly easy to do. What I have a much tougher time convincing people of is, hey, that warm and fuzzy bank account that you have that makes you sleep well at night because it's FDIC insured and you've got $200,000 in it. It's not every person. I recognize that's a ton of money to have in a bank account, but we see it. That's your risk. right? You leave it like that. I know you can sleep at night, but inflation is going to eat you alive. So how do you feel about that? That money that you have losing purchasing power year after year here. You know just as well as I do. You will have a much tougher time separating somebody from that money sitting in the bank account than you will going to them and saying, hey, I think we should be less risky in your stock portfolio.
Yeah, no one jumps on board on that. You can quote them any statistic that you want, but no one will ever say that $200,000 in the bank doesn't help them sleep at night.
Mortgage rates are all over the place, and that could be good for buyers. I kind of doubt it. They're also not really all over the place. They've been...
It's actually pretty tightly range-bound, but...
So over the last 12 months, you've gotten as low as 6% and as high as... Let me give you the high according to Mortgage News Daily, 6.85. So we are within 1 percentage point on the average 30-year fixed-rate mortgage that you have seen for the last 12 months. That does not seem to me to be highly volatile. And in fact, when I look at the last, what do you want to do? Last 3 years here, so that would bring me to June, July of 2023. You've been...
It's got to be a real tight
range, you've been as low as 6% and as high as 7 and 8%. Yeah. So within 2 percentage points. I actually don't think that that's all over the place. Here's their argument, the authors of this piece. You're not going to have as much competition in those homes if you're looking to buy, because when mortgage rates are this high, it prices out more and more buyers. It makes it so that they can't afford it, or they just get discouraged because they have no interest in having a 7% mortgage or a 6.8 or a 6.75% mortgage. And so if you stay disciplined and stay in there and go to those open houses, then there's going to be fewer of them that are lines out the door. While that's true...
it's been 3 years to your point. At what point do expectations reset? I feel as if they have. If you talk with anybody who's in the housing market, my brother and sister-in-law are, and they had bought their first home, a starter home in, I want to say 22 or 23. And they're looking for their next home. The difference in their mortgage rate to the point that they were making, they're like, yeah, we might have to go up 1% or something like that, which they don't love. But ultimately, their expectations are set there that, yeah, we were sitting around 5 and change, and now maybe we have to go up to 6, 7 or something like that. It is not enough to really... Yeah, thanks, Tucker. There's not enough to really... showing that he has young kids. Showing that they are... I just feel like there's less sort of a mental block with the mortgage rates because, to your point of how long we've sat at this point in time, I do feel like it is a little bit more of a tepid housing market in terms of demand, and it does feel a little bit more common that we are past the point in time where these bidding wars, there does seem to be much more of the listed price is something that could be negotiated down. That seems a little bit more prevalent in the conversations that I've had anecdotally.
We will see how the next spring housing market this spring housing market's done. It was a dud of a market. There were not a lot of home sales, mainly because buyers and sellers dropped out because of rising mortgage rates, mostly due to the war in Iran. I don't know that expectations are for much lower mortgage rates by next spring, so maybe to your point, you get some of that used to it effect. But to the overall point, the only people that I see benefiting from these high mortgage rates are really wealthy buyers that can afford just about any mortgage payment or can go in and buy with cash.
Yeah.
If you're sitting pretty in that position, you're right. You will have less competition from other buyers, and you might be able to scoop up something that's been sitting on the market for a while. Otherwise... those higher mortgage rates just mean that you can afford less homes. That's not exactly working in your favor. Let's take a quick break. When we come back, I want to talk about... What do I want to talk about? I think I want to talk about the home being used as a piggy bank. More and more stories about this recently. Credit card debt high, home equity line debt increasing. What does this actually mean? Is it a threat to the economy? That's next on the Financial Exchange.
Smart financial talk whenever you want. Find the Financial Exchange on YouTube. Hit that subscribe button and keep up to date on daily business news from New England and around the country. This is the Financial Exchange Radio Network.
Retirement isn't just one stage of life. It changes over time, and your home should change with it. This is Mike Armstrong from the Armstrong Advisory Group. You may have heard of the go-go years when you're traveling and enjoying the freedom you've worked so hard to earn. Then come the slow-go years when convenience starts to matter more, and eventually the no-go years when safety and support take center stage. Our new guide, Navigating Retirement Housing Choices, shows you how different housing options can fit each stage of retirement. From staying in your home to downsizing to exploring elder life communities, you'll learn what questions to ask before you're forced to make a decision. Get your free copy today by calling 800-393-4001. That's 800-393-4001 or request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. A nursing home stay can cost more than $14,000 a month. Before you assume you have to spend everything to qualify for Medicaid, get the facts. Call 866-848-5699 for your free copy of Cushing & Dolan's new guide, Last Minute Medicaid Eligibility. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. For veterans, every day is a commitment to service. This Veterans Day weekend, be part of something meaningful at the DAV 5K Boston. Join the thousands of runners and walkers at Fort Independence on Castle Island for a day of community, remembrance, and gratitude. Proceeds help fund the programs and services provided by the Disabled American Veterans Department of Massachusetts. To register or make a donation, please visit dav5k.boston. That's dav5k.boston.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
From market moves to retirement planning strategy, follow the Financial Exchange on Instagram and stay up to date on the business news of the day. This is the Financial Exchange Radio Network.
So in mixed news here, we do have a continued and always problem with credit card debt in this country. The average debt per cardholder grew 22.7% from 2018 through last year. That's discouraging, but is almost exactly in line with inflation.
Mm-hmm.
So I don't look at it as, this It was already bad news in 2018. It got worse over the last 7 years, but that mainly got worse because of inflation, and that's the story. As though home equity values have increased, as home values have increased, and therefore equity has increased, the next possible way of borrowing money has opened up some doors for folks through through second mortgages, home equity lines of credit, reverse mortgages, all sorts of different buckets here. And while those have been on the rise too, the fantastic news here is that, owners' equity in real estate has never been higher than it is right now, and is substantially higher than it was pre-COVID levels. Like when I look at, so the St. Louis Fed has a chart here on owners' equity in real estate, and it's just a dollar threshold. It's roughly doubled, just shy of doubled since pre-COVID.
What level do they have it? I had read 17 trillion of equity out there from Intercontinental Exchange is estimated. But bottom line being, it's trended up way higher.
Tremendous level. This is clearly a different measurement because I had about 18 trillion prior to COVID, and now like 30 some odd $30 trillion, so more than doubling. But I don't take this as a good indication. And, the New York Times interviews a Miss Borowski who got an offer from Rocket Mortgage Company to take out a home equity line. She paid off bills, bought new windows, and, still had enough left to take a trip for to see your granddaughter. And I don't mean to de-emphasize, seeing family, but as a 63-year-old retired school teacher, borrowing money for vacations is probably not a very sustainable path. So I think there's good financial planning lessons in here, but if you wanted to try and convince me that problems in the housing market were what was going to sink the economy next, I'd tell you you're crazy.
No, that's certainly not something that is of top of mind in terms of concern. I do feel like the data is interesting because it does sort of provide some evidence behind what is probably a pretty likely trend. You have a lot of homeowners who are sitting on these 3%, 4%, 30-year fixed mortgages, and you're seeing with the second mortgage origination, the home equity lines of credit being layered on, that growth is reflecting that two things are occurring. One is you have high rates of credit card interest out there. So it seems like by this data that a lot of folks are looking for, one, to lock in and continue to hold their 3 or 4% 30-year fixed mortgage and maybe borrow on top of the equity that they've built up because home prices have gone up 50% over the last 5 or 6 years to do that renovation, but not doing that cash out refinance where you do the whole rate over again on your mortgage. So that's one aspect of it. The second is to consolidate some credit card debt that may be out there. That's something that you've bumped into.
None of which is necessarily a bad idea.
No, it's not a bad idea. Where it becomes problematic and not something that we're worried about today is if the economy deteriorated for a significant period of time. Okay, you have people who are a little bit more levered, but it's not to the points that we're at the 2008 levels.
By the way, please beware. If you have a mortgage from pre-COVID or pre-2021, every bank out there is going to desperately try and get you to cash out refi and take that mortgage and convert it into something else. And it may, give you a bunch of cash up front with a relatively small increase in the monthly payment. You do not have to do that to cash out of your home. Mm-hmm. I'm not saying this is a good idea generally, but there are options available to you that do not involve you getting rid of your unbelievable 3% mortgage that you will never see again in your life. You can take a second mortgage. You can take a home equity line of credit. There are other ways than having the bank saying, nope, we're canceling that 30-year mortgage that you have fixed at 3.25%, and now you're going to take out an even bigger mortgage, but at 6.5%, because that is what they would love, 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 love for you to do.
One day you're living in your own home. The next you can't return home after rehab. Now you're faced with a nursing home bill of more than $14,000 a month and wondering how you're going to pay for it. These situations can occur without warning, but Cushing & Dolan can help. Before you make any major financial decisions, get the facts. Cushing & Dolan's new guide, Last Minute Medicaid Eligibility, explains common misconceptions about Medicaid, what assets may or may not be at risk, and why the first answer you receive isn't always your only option. Call 866-848-5800 848-5699 and get your free copy of Last Minute Medicaid Eligibility. That's 866-848-5699, or you can request the guide online at legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Boston Globe reporting on a report from a company called Synapse, who looked at the rate of electricity here in New England and are alleging that households in New England were overcharged by billions of dollars. So I got to be clear about what they're arguing here. They are not arguing that electric utility companies mischarged you, screwed up in some way, and you can, apply for a reimbursement. That is not the allegation here. Instead, what they're saying is that Eversource and National Grid, who don't actually generate the power that they sell, right? They maintain the lines, they buy the power from producers and then sell it to all of us. They are arguing that the rates that they are negotiating with the power generators are obscenely high and too profitable for the generators. And they look at it by saying that, the premium. So basically, those generators always charge a premium to the companies like Eversource and NatGrid. They do that because they don't actually know what it's going to cost them to generate the electricity. They're guessing. And so they build in a profit margin in order to make money. And that margin has been growing over time. The premium has been rising, reaching 49% of the median monthly charge for how much it actually costs them to generate that electricity over the past 5 years. And that's the allegation here. It's not that NatGrid or Eversource is marking things up or that they are misbilling you. They're basically saying that they're doing a garbage job of negotiating with the power suppliers. I don't know if there's any truth to it, but that's the allegation. We got to take a quick break. A lot more to cover in the second hour of the Financial Exchange. We'll be right back. Stay tuned. Retirement isn't just one stage of life. It changes over time, and your home should change with it. This is Mike Armstrong from the Armstrong Advisory Group. You may have heard of the go-go years when you're traveling and enjoying the freedom you've worked so hard to earn. Then come the slow-go years when convenience starts to matter more, and eventually the no-go years when safety and support take center stage. Our new guide, Navigating Retirement Housing Choices, shows you how different housing options can fit each stage of retirement. From staying in your home to downsizing to exploring elder life communities, you'll learn what questions to ask before you're forced to make a decision. Get your free copy today by calling 800-393-4001. That's 800-393-4001, or request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. A single nursing home stay could cost you more than $14,000 a month. That's why so many families believe they'll have to spend almost everything before a loved one can qualify for Medicaid. But that isn't always the case. Cushing & Dolan has created a new guide called Last Minute Medicaid Eligibility. In it, you'll learn how Medicaid eligibility works, get information about last-minute planning options that may still be available, the mistakes that could cost your family, and why acting quickly could give you more options. Don't assume you have to lose everything to pay for long-term care. Get your free copy of our new guide called Last Minute Medicaid Eligibility right now by calling 866-848-5699. That's 866-848-5699. Or you can request it online at legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up.
Because we have something better.
Stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit goredforwomen.org today to learn more.
When a heart stops, the clock starts.
you are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Every mile can make a difference for a Massachusetts veteran. The DAV 5K Boston returns to Castle Island on Saturday, November 7th for a family-friendly day of community, remembrance, and support. Whether you run the 5K, join the 1-mile walk, or make a donation, your participation helps further the mission of the Disabled American Veterans Department of Massachusetts. Honor those who served. Sign up today at dav5k.boston. That's dav5k.boston.
Is it a stroke? Even if you're not sure, act fast and call 911. Signs can include face drooping on one side, arm weakness, speech difficulty, or not making sense when talking. Time is critical. A stroke requires immediate medical care, which starts as soon as the ambulance arrives. So if you see any sign of stroke, act fast and call 911. Visit mass.gov/stroke, sponsored by the Massachusetts Department of Public Health.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about techniques that can help protect your assets from long-term care expenses last minute. Todd, what happens to your home when a spouse enters a nursing home and no planning has been done? And is it different for single individuals?
Yeah, so very good question, and the answer is yes, it is different. So let's talk about the spouse first. When you're married, if you have a spouse living in the home, regardless of the value of the home, as long as it's located in Massachusetts, it's non-countable. And it's non-lienable. So it's really, truly protected. Now, don't leave it that way. Make sure you put it 100% in the name of the healthy spouse after that happens. However, for a single individual, it's a little different. As long as the value doesn't exceed $1,071,000. There's a number that changes every year. It goes up. Then it would be countable if it's worth more than that. If it's worth less than that and you check a box that you intend to return home, it's non-countable, but it's lienable. But so what? Getting on the Medicaid at the Medicaid rate is better than paying privately.
Todd Lutzke and the estate planning experts at Cushing & Dolan have written a brand new guide that details last-minute Medicaid eligibility. You can request this brand new guide by calling 866-848-5699. That's 866-848-5699. Or you can simply request the guide from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning. Welcome back to the Financial Exchange. Mike, Paul, and Tucker with you here on a Tuesday where markets remain relatively calm after last week's massive gains. You've got the Dow, I'm not even going to say down, exactly flat for the day, off by 11 points at the moment. The S&P the same, up 2 points or less than 1/20th of 1%. The NASDAQ down 18 points, less than 1/10 of 1%. So not much movement here in equities in early trading. We do have oil prices now moving up slightly over $82 a barrel, and yield on the 10-year Treasury down slightly to just below 4.7% as we await the July Consumer Price Index data, which we will get tomorrow. Our top story of the hour has to do with the semiconductor sector, NVIDIA, as well as just the general memory and chipflation that we are seeing right now. Let's start off with this piece from Emily Peck at Axios. Why chipflation is here to stay. Does not do a terribly good job answering that question, and I pretty thoroughly disagree with the idea that chipflation is here to stay. But let's walk through what we have already seen on the inflation front due to the AI boom.
Yeah, so what we've seen, the most interesting data point here to note is first of all, many listeners are probably aware of the fact that if they listen to the program, that the cost for chips and servers and everything that goes into building out AI data centers has tremendously increased over the course of the last year or two. In particular, an area of focus and has been a big contributor to the market performance we've seen this year is on the memory chip side of things. And always to simplify this for listeners out there, on your device, whether it be your iPhone or your laptop, there's different memory chips within these different devices that will keep your files in place, your pictures, all this different types of storage. So every time you fire up your computer, you're able to access that information. Those have gone up sixfold over the course of the last year or so. And in particular, that's just the memory side of it. If you look at just everything that goes into semiconductor chips, electronics, and accessories, there's the producer price index, which is basically what at wholesale the cost for these goods. We talk a lot about the consumer price index, but the producer price index, that has risen about 28% year over year. This is a very much anomaly for the chip sector in general. Famously, it has been a boom and bust cycle that goes with chips, and most notably, unlike many other things that kind of trend along a normal inflationary path, like housing and other goods and services that will go up, 2 to 3% over long-term historical averages. Technology has this unique quirk where on the chip front, we've been able to innovate and actually drive costs down dramatically that have not kept pace with inflation. But curious to hear why you disagree with the notion. I guess it's going to come down to whether you think on the chipflation front is here to stay, how long your time frame is on it. Are you viewing that as like here to stay for decades? And is that what you disagree with, or the short term? Because I'm kind of on board with the short term.
I guess we got to define,
stay.
Nobody's going to be able to develop a new fabrication facility and compete with TSMC anytime in the next 12 months. So, yeah, is Apple going to be able to lower iPhone prices in 2028? Probably not.
Mm-hmm.
But, when I think here to stay, I tend to think of longer than the next 12 to 18 months. And the point that I would make is the same one you just made about semiconductors. They are a boom and bust cycle component. And what you're seeing right now is tremendous inflation in every area of that supply chain. So whether or not somebody will be able to directly compete with NVIDIA and make a better chip than they do anytime in the next 5 years, I think is irrelevant, because one thing I'm certain of is that plenty of companies will be able to supply the market with other areas. And what everyone is eyeing right now is the fattest profit margins that technology, hardware, and components have seen in decades. And so everyone and their mother is rushing to throw money into how do I build this stuff and get to market quickly. And what you're going to do is you're going to oversupply the market and you're going to see prices crater. I don't know if that's a 2-year scenario. It might be more like a 5-year scenario. But it's certainly not going to last forever, where prices just, even if demand for all this stuff continues in a straight line upwards as it has, prices still come down in my view.
I agree with you, because not only that, what we haven't talked about besides the supply side is there's going to be innovation on all sorts of different fronts that will allow for alternative solutions to NVIDIA's chips. There's going to be more specialized chips that are created that specialize specifically for different tasks that go into AI that will probably drive down prices. But I would agree with the sentiment if you were taking a short time frame view. And the way AI evolves, 12 to 18 months is kind of like a long time in the cycle. If you want to play it that way for that Axios piece, then I'm on board for the next year or two.
So let's turn then to, you mentioned innovation. Let's talk about everyone's least favorite type of innovation, which is financial innovation, and the effort that's being led by the CEO of NVIDIA, Jensen Huang. His new big concept for artificial intelligence is looping in a bunch of financial experts, like from the likes of Goldman Sachs, because the point that he is trying to make is that semiconductors, while they've traditionally been thought of as this rapidly deteriorating, highly specific product built for niche use cases, are now in fact going to be long-lasting assets that are pretty much fungible. Fungible meaning, you can use the same chip for different processes and there is long-term value to that chip. And why he's trying to convince the financial world of this, to me, is fairly obvious, because if you can convince the general public that instead of what is being plugged into these data centers being a rapidly depreciating asset that was built on, to spec for this one specific company, if you can instead convince them that, hey, it's just like electricity or a mortgage, then I can package them and sell them. And I can get all sorts of new people interested in investing in them because, hey, it's instead of a depreciating asset, it might still depreciate, but it's going to depreciate over a longer time period. And, even if, let's say Tesla buys, 3,000 of these things, well, don't worry about it, because if they need to resell them in the secondary market, there's going to be a secondary market for them to resell them into. Which is all well and good, and you might be able to convince me of that, but I'll tell you, it sounds exactly like taking a bunch of products, dividing them into buckets or, tranches, and then selling the rights to investors who can borrow on them. Tell me if you've heard this theme before. It is the housing bubble of 2008. this happens with all sorts of products, so I'm not saying it is necessarily the wrong approach, but we're, just seemingly months away from having semiconductor-backed securities that you can then leverage to the tilt and sell off to, unbeknownst investors. And here's the problem. This was complicated enough with mortgages. Mm-hmm. Everybody knows how a mortgage works. It's backed by real estate. Can anyone listening to the program right now explain to me the expected depreciation life cycle of an NVIDIA Blackwell chip?
Or the alternative use cases for it and how long those use cases are good for.
By the way, don't blame yourself. I doubt there's anybody at Goldman that can explain the difference to me.
Hopefully some semiconductor analysts out there could.
Like, I really have some doubts about all of this. I do suspect that this is happening. This is not the first I've heard of this. I've heard others out there talking about how we need to set up a financial market for semiconductors, how they are fungible, how effectively we need to create a financial market for compute, which will allow the build out of these assets to happen more rapidly. But understand what they mean by that. What they mean by that is they want to create a market for a product that they can sell to you.
Right.
You are the one that is going to fund that build out if they are able to do this. Because guess what? Goldman's not going to be the one investing in it. They're going to be the one building it and selling it. So, just buyer beware of what is happening here, right? When they talk about the commoditization, or not the commoditization, when they talk about the financialization, when they talk about these things being fungible, when they talk about wanting to create a secondary market for it, all of that means they want to build something that they can sell to you, the investor. Maybe it's a great investment, maybe it's a really poor one, but that is the entire use case that they're talking about, because right now, the only market for this stuff are the big giant companies that can afford to buy it all. They want to create another market for it.
Yeah.
It doesn't seem like a great deal to me. Let's take a quick break. When we come back, Intel in the news after a big share sale. These are new shares that are being listed on the market. I want to talk about this because they are not the only ones doing it here, but there is a pretty distinct difference when we talk about Intel. That's next here on the Financial Exchange.
Market insight, retirement strategies, real talk about Wall Street and economic trends. All live every day on our YouTube channel. Go to youtube.com/The Financial Exchange Show. This is The Financial Exchange. A nursing home stay can cost more than $14,000 a month. Before you assume you have to spend everything to qualify for Medicaid, get the facts. Call 866-848-5699 for your free copy of Cushing & Dolan's new guide, Last Minute Medicaid Eligibility. That's 866-848-5699, or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. For veterans, every day is a commitment to service. This Veterans Day weekend, be part of something meaningful at the DAV 5K Boston. Join the thousands of runners and walkers at Fort Independence on Castle Island for a day of community, remembrance, and gratitude. Proceeds help fund the programs and services provided by the Disabled American Veterans Department of Massachusetts. To register or make a donation, please visit dav5k.boston. That's dav5k.boston.
The biggest retirement decision you make may have nothing to do with your investments. This is Mike Armstrong from the Armstrong Advisory Group. You've worked hard preparing your finances for retirement, so take the time to think about whether your home will still fit the life you want to live. The house that's perfect today could become more work than it's worth a few years from now. Stairs, maintenance, a big yard, or even being too far from the people and places that matter. Our new guide, Navigating Retirement Housing Choices, walks through the different stages of retirement, the housing options available, and the questions you should be asking now before a decision becomes urgent. Get your free copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Our Senators Edward Markey and Elizabeth Warren and Representative James McGovern are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Remember, you can watch the show live every day on our YouTube page. We've got market updates and breaking business news all morning long, plus a full archive of all our show's content. It's all there with the click of a button at youtube.com/The Financial Exchange Show.
Before we get started, I wanted to mention again the event hosted by the Armstrong Advisory Group 9 days from today, August 20th. It's a Thursday out in Framingham. We are going to be talking about the two probably most important subjects for retirees, or at least the two subjects that I get the most questions on: Social Security, Medicare. Your essential questions answered here. We're going to be hosted by Susan Powers and Effie Vasulis, and I've attended two of these things so far, and just my takeaway, other than the fact that they do have a lot of really detailed information that you will want to know about how these programs work in your specific area for your specific tax situation. All the ins and outs that you would come to expect about, different strategies for how to maximize the benefits, how it works if you're divorced or widowed. Like, all of these things are pretty complex, and we cover all of that and more. But specifically, at the last two, there's been time for questions after the fact, and that's where the really interesting questions have happened is, I've got this specific situation. How does this affect me? And so if you are heading towards retirement, I know you've got questions about these two programs, how they work, how long they're going to last, how the trust fund's set up, all of that and more addressed in this presentation on Thursday, August 20th at the Renaissance Framingham Hotel. Space is limited. You do need to register in order to attend. So call now at 800-393-4001 for your free ticket to attend. Again, retirement planning seminar on Social Security and Medicare, 5 p.m. on Thursday, August 20th in Framingham, 800-393-4001 or armstrongadvisory.com/events.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
So speaking of companies that want to build semiconductors and sell to the AI demand, Intel has raised $20 billion in a share sale. It's about a third more than they were targeting when they announced the deal on Monday morning. And not surprising, Google's done this. Pretty much every major AI hyperscaler out there has been trying to raise cash for this build out to profit on it. The only question I have is, as an American taxpayer, did I just get diluted? I think I did. The
Yes.
U.S. government owns how much?
10%, I believe.
10% of Intel, so now like 9.8 or something?
Yeah, to be fair, it is up 165% year to date. So
since we
you
made
were,
that
you
investment,
were doing okay. Well, year to date, I forget when the terms were struck with the U.S. government investment.
So far, still coming out on top.
Yeah, diluted.
These are
but
not the
still
questions that our government should be asking. Right? Like when Alphabet decided to issue new shares, it was no business of the United States government as to whether or not they went to do so. All that we required is that you disclose it properly to investors. Here, the U.S. government physically owns shares in Intel, and whether you think that's a fantastic idea or the worst idea in the world, the fact of the matter is that suddenly questions like this are the subject of, will it hurt or harm the U.S. taxpayer? And I think that muddies the waters way too much. And two, if you think it's the best idea in the world, my second question for you is, do you think that the next president, whoever that may be, but put in mind the person that you would think would be the worst at managing the AI boom and shares in Intel, imagine that they are the next president. Are they going to be as good a steward of these shares as the current president is? So I think that this idea was flawed from the beginning. I think if there are strategic industries that we as a nation feel that we need to support for national security or strategic reasons, I am open to that debate, but I really think that using money that was approved by Congress for the CHIPS Act to invest in companies is the wrong move, because investments can take 2 decades to play out, and our political system just isn't set up for that.
No, I was going to go, I know you went with the ownership state of the government. I was going to go more to just the overall amount of just demand that continues to underlie these companies in the AI trade. This offering got upsized from, I believe, initially $15 billion to now $20 billion. There just continues to be a tremendous appetite. And say what you will, Intel has had some revenue growth to show some of the reason behind the returns that they've derived year to date, but ultimately it's been a business that had been floundering for years in the past, and just investors are really willing to continue to keep on their rose-colored glasses for anything in this space.
Here's the other problem. Let's say I am some lab at some university, or forget about a university. I'm some privately held company that is looking to get into the space, and I find that I can make the exact type of chip that Intel's doing with some new innovation at a lower cost. Am I willing to enter right now? Right? Like, hey, I just found out that I can make this chip that is going to completely put Intel out of business, or at least significantly challenge their revenue stream. But the U.S. government owns 10% of that. Do I have any confidence whatsoever that I'm going to be allowed to sell my product into the market and screw up Intel's business? Or are they going to be basically forced and required to buy me out because the U.S. government has a stake? Like, again, I know that I keep going on different subjects.
I think that's a little too dire. But there's already competitors in the space with Intel. Intel doesn't have the most cutting-edge chip out there in terms of their infrastructure. AMD is right along the lines with them. So I just don't know. It's a hard slug to just start up as a startup and go into the chip manufacturing.
If I'm Goldman, if I'm a private credit firm, I'm not lending that company any money. That's a huge risk. I don't know how the U.S. government is going to react to this company starting up. So, I mean,
I think the reason you wouldn't get money is lesser because of the government ownership stake and more so of just how capital intensive that industry is in general and how many flush competitors that you'd be up against.
Perhaps I'm overstating it, but yeah, I do not like the U.S. government taking equity stakes. We got to take a quick break. When we return, Wall Street Watch coming up next.
bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
The biggest retirement decision you make may have nothing to do with your investments. This is Mike Armstrong from the Armstrong Advisory Group. You've worked hard preparing your finances for retirement, so take the time to think about whether your home will still fit the life you want to live. The house that's perfect today could become more work than it's worth a few years from now. Stairs, maintenance, a big yard, or even being too far from the people and places that matter. Our new guide, Navigating Retirement Housing Choices, walks through the different stages of retirement, the housing options available, and the questions you should be asking now before a decision becomes urgent. Get your free copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. One day, you're living in your own home. The next, you can't return home after rehab. Now, you're faced with a nursing home bill of more than $14,000 a month and wondering how you're going to pay for it. These situations can occur without warning, but Cushing & Dolan can help. Before you make any major decisions, get the facts. Cushing & Dolan's new guide, Last Minute Medicaid Eligibility, explains common misconceptions about Medicaid, what assets may or may not be at risk, and why the first answer you receive isn't always your only option. Call right now, 866-848-5699, and get your free copy of Last Minute Medicaid Eligibility. That's 866-848-5699, or you can request the guide online at legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive. Most of the time, it's because no one nearby performs CPR. Every walker who joins HeartWalk means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Find your local HeartWalk at heartwalk.org.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Hi, this is Chuck and Mike from the Armstrong Advisory Group. We have a guide available this month titled Navigating Retirement Housing Choices. Mike, when we look at the considerations for people in their housing and retirement, one that comes up are these continuing care retirement communities, CCRCs, or age-in-place communities as they're known. How does someone make a decision about looking at one of those?
Well, I think obviously you have to sort out your priorities, but the first thing is to think long-term about this. And what people sometimes overlook with these places is that term continuing care means that they adapt to your needs over time, but they do not just allow anyone in. In a lot of cases, they will have cognitive and physical tests that you need to pass in order to be accepted into these communities that then will provide all sorts of care later in life. And so I think early on is always better if you're considering that sort of thing.
The financial aspect of these also has a number of considerations as well in terms of what's actually affordable given your particular budget and liquidity.
Do I need a buy-in? Am I going to rent a place? What are my options for later in life? And then all sorts of tax considerations. Hey, I really want an income tax-free state. Well, is that worth it if I'm going to be paying more in property taxes given the composition of my assets and income? All of these really important considerations.
The guide this month is titled Navigating Retirement Housing Choices, and you've got a couple different ways to request it. First, you can call 800-393-4001. The second choice, you can go to armstrongadvisory.com and request it there. Again, that website is armstrongadvisory.com, or you can get it by calling 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets mostly quiet ahead of tomorrow morning's inflation reading, with more turmoil in the Strait of Hormuz after the Wall Street Journal reported U.S. forces fired on a Panama flag ship that attempted to run the American blockade of Iranian ports earlier this morning. As for potential deal, Pakistan's defense minister said the U.S. and Iran are, quote, close to some sort of arrangement. Right now, the Dow is down only 40 points, about 0.1%. S&P 500 down 0.1%, or 8 points lower. NASDAQ down over 0.25%, or 74 points lower. Russell 2000 is up about 1/3%. 10-year Treasury yield flat at 4.69%, and oil up about 0.5%, trading at $82.50 a barrel. Intel now edging higher after the chipmaker increased the size of its stock offering to $20 billion, higher than the $15 billion it previously announced. Meanwhile, Bitcoin miner Riot Platforms has seen its stock rise about 4% after Bloomberg reported the company secured a $9.1 billion cloud deal with Anthropic. Elsewhere, shares in Hims & Hers falling 1%. After the telehealth company trimmed the upper end of its full-year EBITDA outlook. Swiss sneaker maker On Holding posted mixed second-quarter results and reduced its full-year revenue guidance, sending the stock plunging by 18%. And after today's closing bell, we'll see earnings from CoreWeave and Super Micro Computer. I'm Tucker Silva. That is Wall Street Watch.
There's a writer, David Conti, who studied retirement planning and has been writing about it for quite some time. And he created a fear index, which is not useful to us yet because he only created it in the last couple of years. But he goes out and surveys people. And specifically, he's talking about financial fears about inflation and markets and healthcare and all sorts of different things that impact mainly retirees. What I find interesting about it is he makes what I believe to be a really valid point, which is people don't make decisions based on all of the modeling that Paul and I like to do as financial advisors. We like to test out and stress test things and model out income versus expenses. And while it would be nice if clients made decisions based on the logical models that we build, they don't. They make decisions based on fear, and or at least that's the argument of David Conti, who wrote this piece and has been talking about it, and that's why he created this fear index. Is okay, when it gets high, you can plan on clients reacting or individuals reacting to things in an unpredictable fashion, I guess is how I would describe it. What do you think are some good strategies, not for clients of ours, Paul, but for the average person out there to do what they all know that they should do this, but take the emotions out of financial decision making, because everybody knows that emotional decision making tends to be garbage decision making and can have real problems on your financial scenario. So what are some strategies that I know you employ with clients and I've employed with people and myself to make it at least easier to take the fear piece out of the whole decision-making process?
Having a plan can provide some sort of solace when you get into difficult times that, hey, this is the way our portfolio is constructed. We have set aside these assets that have lesser risk than the equity markets that we could lean on if markets get bad. Sort of even just presenting it as at some point markets will be down and your portfolio will be far lesser than it is today. So how do we talk about that when times are going well and institute this idea of this is what we are going to do when times get bad? Because that way, when it does come up, the conversation isn't new. You've mentioned it before, and you've got a plan in place. The second thing that I feel is really helpful is so few people have a good understanding and education as to why they own stocks or why they invest in the market.
Or in specific stocks or specific parts of the market.
Yeah, and I think providing the framework around the inflation hedge that stocks can act as, the ability to be a shareholder in companies as they continue to strive to grow their earnings year over year, and sort of what that means to be an equity owner and what you're ultimately investing in is helpful context, because that can take some of the emotion out of the cyclical nature of our economy. There's going to be good times and bads, but if you understand why you're doing what you're doing, that can also be helpful to lean on when times get challenging. The education and the planning piece, does that solve everything? No, there's always going to be people who are emotional regardless, but I feel like those two are a good step. And a client, I'll throw in a third, not looking every single day at their portfolio is another one that's very easy to kind of institute yourself. Had someone who started and just was looking at it daily and sending updates to me on how their portfolio is doing. And it's like, we're in this for 10 years. I don't need for you to tell me, first of all, you better believe I'm looking, so you really don't need to update me on a daily basis. But second of all, we're looking at this for 10 years. We're not looking at this every 10 days or every day, the update on how the portfolio is growing.
I think the feeling educated piece is an important component to that. And it also sets up a bit of a conflict, because part of the reason you hire a financial planner or investment manager is because you don't feel like you can or want to handle it yourself.
Good point.
Right? Like that's the.
If
I'm perfectly well educated on financial well-being and investments, then I don't need a financial planner. I hire somebody like that because I don't feel like I know all the ins and outs of tax planning, retirement planning, investment decision making. But if I fully outsource it to that person without understanding what it is that I'm doing, then the first time it goes wrong, I'm going to panic. And so it does have to be this happy medium where, yeah, I don't want to be the one in charge of those decisions, but I darn well had better pay attention, understand, and get educated on how it works, or just be the most trusting person in the world, which comes with its own problems, as we've seen from Ponzi scheme after Ponzi scheme, where people, take misplaced trust and abuse it. And so it can put you in a pretty difficult position there, where you need to find a happy medium where, yes, I understand what I am doing, I understand what I'm owning, investing in, but I don't want to understand the intricacies of it to the point where,
that you're in the weeds of it. I mean, it's a great point that you make, because so many people give you that refrain of like, hey, this is why I'm hiring you to do it. And totally, I completely understand that. But think about the working relationship that you might have with your electrician, or if you're doing a renovation with a contractor. You don't need to understand every in and out of the plan that they may be instituting to, redo your home. But you should have a good idea. He or she should be able to relay sort of the framework and the approach, and you should understand the generalities behind it. I think the same thing kind of applies when you're hiring them to when you're hiring an advisor.
Anthropic, gearing up for a fall IPO, is hitting the road to try and beef up demand for their shares as they look forward to what would be likely a $1 trillion+ initial public offering. They're traveling out there. They're $965 billion AI juggernaut. It would be the second largest IPO of the year, maybe the second largest in history next to SpaceX. And you'd be not quite a household name as SpaceX, but because everyone's getting this very rapid class on what artificial intelligence is and how it's working, I think most are starting to realize that, Anthropic, the creator of Claude and Mythos and these different models, is generally hopping between one or two in terms of the most advanced AI companies that are out there. What will be really interesting to me is actually getting a sense for what their financials look like.
Yeah, I mean, the one thing that has been mentioned with Anthropic is they have seen tremendous revenue growth. Their annualized revenue rate has been growing at a really rapid pace, as reporting run rate of topping $47 billion earlier this month. This is a company that was only founded, I believe, 5 or 6 years ago. So to be able to run at a projected 12 months ahead, $47 billion revenue over the course of this span of this short of a time is incredibly impressive. They are really the most cutting edge, I think it's, viewed by the artificial intelligence community, the most cutting edge models at this moment in time. What they have to sort of assuage sort of some doubts on is there are popping up more and more open source models. So the models that Anthropic runs are proprietary in nature, but there have been many Chinese imitators and just other open source models out there that would ultimately dilute their brand to a degree. So that is one of the challenges that they're facing, as well as just the overall sentiment on artificial intelligence that this country has. There really needs to be a shift in the way that this is presented to calm some of those fears too. Those are probably two of the biggest things that they're trying to address on this roadshow here.
No doubt. Let's take a quick break. When we return, a bit of Stack Roulette is next.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
The biggest retirement decision you make may have nothing to do with your investments. This is Mike Armstrong from the Armstrong Advisory Group. You've worked hard preparing your finances for retirement, so take the time to think about whether your home will still fit the life you want to live. The house that's perfect today could become more work than it's worth a few years from now. Stairs, maintenance, a big yard, or even being too far from the people and places that matter. Our new guide, Navigating Retirement Housing Choices, walks through the different stages of retirement, the housing options available, and the questions you should be asking now before a decision becomes urgent. Get your free copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. A single nursing home stay could cost you more than $14,000 a month. That's why so many families believe they'll have to spend almost everything before a loved one can qualify for Medicaid. But that isn't always the case. Cushing & Dolan has created a new guide called Last Minute Medicaid Eligibility. In it, you'll learn how Medicaid eligibility works, get information about last-minute planning options that may still be available, the mistakes that could cost your family, and why acting quickly could give you more options. Don't assume you have to lose everything to pay for long-term care. Get your free copy of our new guide called Last Minute Medicaid Eligibility right now by calling 866-848-5699. That's 866-848-5699. Or you can request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined. For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up.
Because we have something better.
Stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit GoRedForWomen.org today to learn more.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all.
Visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Stay informed and prepared for market changes and breaking business news. The Financial Exchange is live every day on YouTube. Tune in, subscribe, and keep up to date on all of our show's content on a daily basis. This is the Financial Exchange Radio Network.
The 2026 DAV 5K Boston is set for Saturday, November 7th at Fort Independence at Castle Island. If you want to participate, now's the time to register. More than 800 runners have already signed up, making this the fastest registration pace in history. The event will be a sellout soon, so head to dav5k.boston for all the information on how you can take part. And if you can't, please consider making a donation. Your gifts help fund free rides to medical appointments for veterans in the nation's first DAV-led housing initiative, providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today. That's dav5k.boston.
Time for a bit of Stack Roulette. What do you have for us, Paulie?
Mike, always fascinated by Waymo and its development of autonomous vehicles. These articles I will never not read and probably never not talk about, because I do feel like I'm an optimist, and I'm optimistic that in the future maybe the burden of driving is removed or lessened for all of us out there. I totally understand there are other family members in my camp, like my wife and mother-in-law, who think that I'm crazy for thinking that. Quote me on that. And would never go into an autonomous vehicle. But what we're seeing here is probably a natural progression in the industry where they've quadrupled the amount of vehicles that they have on the road. Waymo, so Waymo is owned by Google, and they had about 700 vehicles on the road last year. Sorry, they 5 times the amount of vehicles. Now they're up to 4,000 today. And what they're running into more and more frequently is what we all know about driving, that it's not the same every single day. It's not completely predictable. There are situations like the one outlined out here in this New York Times piece that on July 4th, there are fireworks that are going on throughout all of the country. There was 100,000 people packed in San Francisco's waterfront area to watch the fireworks that shower over the Golden Gate Bridge. Unfortunately, Waymo did not get the memo, even though they actually had tried to prepare for this. And what ultimately ended up occurring is that several Waymos just stalled out and would not move and were stuck on the bridge, making for 5-minute drives turn into an hour-and-a-half drives, and emergency vehicles having to show up at the scenes to get rid of these Waymos that had stalled out. There's other stories out there like this where in a construction zone on the highway, right lane was closed down. 2 folks driving in a Waymo saw its vehicle swerve through the cones and drive like a, quote, scared animal to try and swerve around some of these traffic cones that were put out in the case of a construction highway scenario where a lane was closed.
Well, you missed a really good part of it, where not a good part, but a funny part, where a couple got into a Waymo. Somebody lit a firework in the middle of the road, and the Waymo, not understanding what a firework is, just drove over it as it exploded underneath the car. Apparently survived that explosion. The car did not light on fire, or at least not immediately, but
stalled out at the next
intersection, and they had to exit the vehicle, which can in itself be a challenge. There's still some kinks to be worked out. There's one thing about this that I have not understood why this is the case, but for those that aren't familiar, all of the Waymos are, I believe they are Jaguar electric vehicles.
Right.
That's who actually manufactures these things. And you go take a look around at the other companies that are trying to do this. They're all electric vehicles, and I don't really understand why. They don't need to be. The hardware doesn't need to.
There's a reason behind it. I'll try and find it here, but there is a reason with the design that does require for them to. It's something with the battery and the sensors on it that it is typically required to be an electric vehicle. But
I'd be interested to understand why, because to me, there's a lot of people that are interested in EVs but not in self-driving vehicles. There's a lot of people that are interested in self-driving vehicles but not in electric. And other than a few products from General Motors and Ford that are being rolled out, if you want any of these self-driving features, they're pretty much exclusively in electric cars and SUVs, and I just haven't really understood why that is the case. So
they do not have to strictly be electric by the laws of physics, but self-driving systems require instant mechanical precision, steady electrical power, and low-maintenance software control that gas-powered engines cannot reliably provide.
Interesting.
That's why you often see.
So
that.
Somebody smarter than me already thought.
I'm also
this.
seeing like EVs have more predictability in terms of braking as opposed to gas-powered engines.
Exactly.
Yeah, that's true. Okay. That's I guess something of an explanation. The problem is that when they are forced to sit in hours of traffic, they run out of electric charge, but I guess that could happen with a gas engine as well. Speaking of gas, electric, and hybrid vehicles, with gas prices shooting up, guess what is becoming popular again? Not so much the EVs, which is surprising to me. There's not a tremendous surge in demand for those, although you are seeing some uptake. Remember that to take advantage in some of the federal subsidies for EVs under the Biden administration, one of the ways you could do it was by leasing one of these electric vehicles, and now those lease periods are coming up and they are turning in those EVs in droves, so some of those are coming onto the market. But hybrid cars seeing a real resurgence, which we've called this out before, but the foresight of Toyota to, go left when everybody else was going right and really be criticized for it during COVID. Like, every company out there was racing to develop an electric vehicle, buying up battery plants, buying up the rights to future battery power. All sorts of new companies, Polestar and Rivian, were getting bid up in the stock market as they, listed their shares publicly for the first time ever. And all the while, Toyota's just kind of limping along, continuing to explore hydrogen vehicles and push hybrids. And lo and behold, half a decade later, those companies that really spent a lot of money on EVs are struggling.
They wrote down a lot of those business investments at GM and Ford, and here you have Toyota on track to retake the lead in U.S. sales from General Motors. And I remember reading the articles, they were heavily criticized for not
investing. I think they had a CEO
EVs.
that had to resign over it.
Really?
I have to go double check, but I think a CEO resigned over this controversy of not developing EVs, and lo and behold, a few years later, they are in the catbird seat. Markets are moving slightly lower. NASDAQ now off 0.33%. We'll have a full market recap and an inflation read for you tomorrow on the Financial Exchange.